Good morning, everybody. Welcome to this third session of the European Issues Capital Markets webinar series. My name is Robert Koller, and I will guide you through this panel today. We have a round of very distinguished guests, and I would like to thank them for joining. Thank you also on the screens for joining. I will introduce them briefly so they can also then say a few words to themselves, and then we will start the discussion. A special thanks to Adam Shaw and Scribestar for sponsoring this session. And please note that you have an orange button, I have been told, at the bottom right where you can pose questions. Which we will discuss during the webinar. So please do submit questions and make them critical. First, I would like to introduce Peter Kerstens, who is Advisor for Technical Innovation and Cybersecurity Horizontal Policies at the DG FISMA of the European Commission. Peter, welcome. Do you want to say a few words about yourself?
Well, thank you very much. Yes, as you said, I'm Peter Kerstens. I advise the DG for Financial Services and Financial Stability on technological innovation, digitalization, and security. And it is a pleasure to be on this webinar. It's about the digitalization of capital markets. And for us, we talk, of course, a lot about Capital Markets Union. But one thing is clear to us is that Capital Markets Union will not be if it is not digital. So I'm happy to talk about that.
Thank you very much. Next, Friedrich Leutlen, Global Head of Debt Capital Markets at DZ Bank, seasoned banker in the space and very deep into digitalization. Fritz, welcome, and maybe you can also give us a bit more background.
Thanks, Robert. Yes, indeed, I run DCM here at DZ. I'm involved in a couple of digitalization initiatives internally. Engine and ESG Locator, some of the digitalization projects that we've launched fairly recently into the market, and then of course I'm also involved in the DMCG of the ECB, which is the current market contact group that the ECB runs for digitalization of the debt capital markets. So that's just a little some further words. Thank you, Robert.
Thanks, Fritz. Next, I will jump to Hervé Labbé, co-founder and CEO of NowCP, a digital platform in France, and former treasurer of Orange. Hervé, please give us a few words about yourself.
Yes, I was, as you mentioned previously, I was deputy treasurer of Orange in charge of the trading room on financing. And I am the co-founder of NowCP and the CEO.
Thank you very much. Last but not least, Adam Shaw. Adam, maybe you can introduce yourself, and Adam will also give us a quick overview about the topics to come and about his company, Scribestar.
Yeah, hi, my name's Adam Shaw. I'm the founder and executive chairman of Scribestar. My background is investment banking and private equity, and so I've seen a lot of the kind of the big complex documents that are related to capital markets from either a banking or a principal side. But I helped found Scribestar with a mission to reducing the cost and time for companies to come to market by looking at how to sort of digitize and use technology to improve the whole process.
Thank you very much. Maybe a quick word also about me before we jump into the slides. I'm an executive chairman and founder of European Primary Placement Facility, which is the Luxembourg representative of European Issuers as well. I'm a lawyer by training, so I come also from the documentation side, as Adam said, and EPPF is a bond automation and issuance platform. Having said that, Adam, please guide us into the topic.
Okay, so if we go to the first slide. So we're here to talk today about digitalisation and how technology is impacting capital markets, in particular focused on the listing and compliance side. On the slide you can see I focused on 5 key areas that I believe are driving technology changes within Europe in this listing and compliance space, being general tech trends, the CMU, listing and ongoing obligation problems, stock exchanges, and adoption issues and drivers. What we're going to see is that although technological innovation in capital markets is high on the trading settlement sides, those are the sides where there's the most day-to-day financial gain. In listing and compliance, there's a strong regulatory aspect driving technology change, i.e. the CMU, but regulatory drivers are not enough on their own to drive changes. SMEs and companies are looking for the cheapest sources of capital, and listing needs to be competitive compared to other forms, such as private equity. One key problem in creating the structured data sets needed for automation is that market participants and advisors in the issuance process working in isolated work streams, preparing documents, or regulators reviewing documents, so they can't drive the change as a whole. I believe stock exchanges are going to be a key driver as they are the ultimate beneficiaries, but ultimately the market needs technologies that work, are regulators receptive to using them, and an exchange willing to push the advisors and lawyers, etc., to ensure that technologies are adopted. This combined approach is how we see that the issuance side is going to drive down costs for all issuers. So if we go into the first point here, general technology trends. These are really the enablers. Without these, we wouldn't be able to see any of the technological shifts and the move to digitalization of capital markets as a whole. If we look at some of the key trends, cloud computing. Maybe 10 years ago it wasn't seen as secure, but now it's seen as a way to boost and support market infrastructure and allow for scalability. This is something that was made very clear during this whole COVID pandemic. API-enabled environments. These allow integration and interoperability of market infrastructure with third-party solutions. Increasing data and the ability to have data analytics. Financial information is becoming data flows, and it increases the way that data can be collated, reported, and analysed. And data being machine readable or structured data is essential, and we'll come back to this during this discussion. With the increase in data and the usability of data, that allows automation, and that allows the improvement of workflow architecture. With automation, then comes improved automation through artificial intelligence. And lastly, we see new technologies around which are being explored to see if they can disrupt or improve processes for either easing the ability to raise capital, such as blockchain, tokenization, creation of new investment vehicles and assets. And we can see real-life impacts of these technologies. We've seen an increase in equity culture with growing retail investment, which has been driven by financial apps that people can just put on their phones and start to invest in markets. We've seen startups that give retail investors better access to IPOs. And there's an ease of access of data as well. Company websites giving information to their results, investor presentations, websites that can give you comparable companies. There's a growing level of information out there. ESG and sustainability, we should touch upon. This is of high interest at the moment, and we're seeing a lot of research going into how this can be measured, monitored, and reported. But along with this technology, there are also a great deal of manual processes still. And this is where startups like ourselves are trying to sort of look to automate things and improve processes. And again, regulatory burdens. This is going to be a key topic because companies find it expensive and time-consuming, particularly SMEs. And there are technologies being developed that are trying to ease these applications rather than easing the regulations. As we've seen with the easing of documentation for SMEs by the CMU, or for the easing of COVID-related equity raises. With the enablers, we then have the political drive, and this is really the CMU. The CMU is probably the most important and biggest driver of digitalisation from a regulatory perspective. Their focus is on improving listed capital markets across Europe, how to get more people to invest, how to get more companies to list, how to get monies to flow regardless of location. In the high-level forum document, they made 17 recommendations, which included things such as crypto and tokenization as alternative sources of capital, building retail investors' trust in capital markets. But probably the biggest item that they concluded impacts digitalization and automation across the whole of Europe and within each of your companies is the European single access point. It means for investors, financial and non-financial information needs to be structured, easily available and comparable across EU markets. XBRL will clearly cover financial data, and things like the European Single Electronic Format will ensure that data is homogeneous. but work on non-financial information is not clear yet. It's hard to imagine how a prospectus or a large complicated acquisition document or rights issue document can move to structured data, given today's processes. If it's a large listed business, if you're a large listed business and you have concerns about having to report in structured data, imagine the same for an SME that is also considering an IPO. We know that the CMU and FESA, the Federation of European Securities Exchanges, are keen to drive increased market access for SMEs, but we also know that fewer and fewer SMEs are actually listing, a long-term trend now, and we believe that that's driven by our third point here, the listing and ongoing compliance problems. If we look at the listing side, then this process is highly manual, with most exchanges still typing in manually basic information from prospectuses into their systems. And the prospectuses are still static documents. We still see PDFs with static financial information, while the market is moving towards XBRL filings for ongoing reporting. And on the compliance side, we've seen regulators receive PDFs for submissions, but in the background, the process is still the same manual process for reviewing a document. For companies, especially SMEs, going to market and staying in the market needs to become cheaper, faster, and overall a more attractive proposition. And the CMU has proposed a number of regulatory measures, such as the growth prospectus, reducing the regulatory burdens for companies of a certain size, a public IPO fund backed by the EU to improve that. We believe we have to find a way to strike a balance between reducing the level of information, as the intention and recommendation of the CMU, versus ensuring credibility and accessibility of information relevant for quality investment decisions. There is a need for good regulation and for good levels of information. And to do this, we have to go back to the first bullet where we talked about data sets. And so if we get proper data sets and structured data, then automation can occur. And with automation can come efficiencies. And we've seen the start of how things might look. If we look at debt issuance, we've seen the start of homogeneous data sets being used to create more efficient data bond issuance, like EPPF on the panel here today, where they can create data sets that all parties buy into and can then use to trade. But other than that, in the more complex bespoke area with IPOs and complex debt instruments like high yield bonds, this is where ScribeStar has been operating. But who can drive these changes to more structured data approach? This is where I think the stock exchanges are very important. They're ultimately the biggest beneficiaries of lower issuance and regulatory costs. Lower cost to market with good liquidity means more companies will come to that market where they will then get more liquidity and then more companies come to market again. So there's a virtuous circle. Competition between exchanges drives expansion and improvement of their offering to companies. Easier and cheaper access to capital means better technology that they can invest in to ease the regulatory processes. With CMU action points, exchanges can help to drive markets to a more digital approach. We've seen this particularly in SME-led exchanges like Aquis, where cost to market is critical, and we've been working them to sort of talk about how they can utilize the current regime with the regulatory framework, but with technologies such as ours to make the market go more digital and become more efficient. We know that ScribeStar can drive efficiencies by getting lawyers, the regulator, and the exchange to work in a single digital ecosystem with a single data set to drive costs down. And we've seen, as an example, in prospectuses in the UK, that we can reduce by about half the amount of time to produce a prospectus. If the exchanges drive this process, then the key issues and their advisors can all work in a digital manner within that exchange, creating the structured data set and allowing automation to come through. But we also have issues because there's adoption issues and some of the drivers around adoption. So if all types of technology and their capabilities are increasing and the regulation is driving major themes in technology change and the exchanges benefit so much, what actually stops technology being adopted? Well, we've got a couple of polls later on whilst we're doing the panel, which will start to ask some of the questions from you to see what your experience is in this. But we believe some of the key preventative technology, for issuance is a lot less clear as to where the benefit is in terms of technology adoption. If you're an exchange, how do you justify investment in an issuance process for an IPO when it's data and trading that is really where you're making your money from? Is listing just an enabler, or does it really attract companies to market? Do companies list on a specific exchange because it's a low listing cost, or because of the liquidity and access to capital? And does the capital come there because it costs less to issue equity there, or is it because they have the more companies and the greater information and availability of data to be able to trade more efficiently? If ultimately it's a driver of capital to a market, then the exchange will be asking itself whether it should own the technology to give it a competitive edge. And therefore, there's also a discussion about proprietary technologies or more open technologies. One thing that COVID has highlighted, however, is that digitization is very important to exchanges and to markets. And there's been a rush to see what process can be done remotely, what can be improved with seamless data flows. And even the EBRD has said that what it wants to see in capital markets in growing economies is digitization so that they become stronger and more resilient. What we can see is technology can improve markets, keep capital flowing, and allow the bounce back of economies in a much quicker way. So I come back to where I started. In listing and compliance, there's strong regulatory aspects driving technology change. But regulatory drivers are not enough on their own to drive technology changes. SMEs and companies are looking for the cheapest sources of capital, and listing needs to be competitive compared to other forms such as private equity. And because market participants and advisors in the issuance process are often working in isolated work streams, we've seen the more disruptive SME-focused exchanges look to drive adoption of digital issuance technologies because SMEs need capital and they need it at an attractive cost. And ultimately, a market needs a technology that works, a regulator that is receptive to using it, and an exchange willing to push the advisors, lawyers, etc., to use those technologies and adopt them. And this combined approach is how we'll drive down cost for issuers. If we could just change to the next slide. Finally, just to talk a bit about the digitalization process, from within the market with our technology. We've created a digital platform that allows smart issuance of equities and complicated debt products. Entry of information for listing documents and regulatory filings works in a way that advisors and lawyers work today. So they're working in a process and a workflow that they understand and feel comfortable with. But as they're entering information in our system, in the background, we create it into structured data. And as I said before, this structured data allows automation. And bringing in automation for lawyers, regulators, and exchanges brings efficiencies, reducing costs for SMEs and other issuers. And by focusing on the way they work today, we've seen that people do adopt the processes in this way. On our system so far, we've had over 50 prospectuses to date, and that's a variety of different documents, including IPO prospectuses, retail bonds, high-yield bonds, takeover documents, schemes of arrangement, so the complex, bespoke documents. And with structured data and exchange-focused approach, this is how we can bring in automation to reduce issuance costs and make it more attractive for companies to come to market. So I'll pause there after sort of like discussing ourselves and go back to Robert so he can lead the panel discussion.
Thank you very much, Adam. I think this has been a very good introduction, and I would subscribe to everything that you've just said from our own perspective. I think before we dive into the discussion, we have prepared a few questions for the audience. So I would ask all listeners and viewers on the other side of the screens to please answer the following poll questions. And the moderators to put them live. The first one is, which areas of capital markets have seen technology improvement according to your own experience? We have a few answer options: investor relations, trading and settlement, debt issuance, equity issuance, shareholder reporting, exchange services, or regulatory review. And the second question, which we would like to ask you, is more forward-looking. Which of these areas of capital markets do you feel would benefit most from technology? And again, the same answer options. So please have a look at those questions, hopefully popping up on your screen somewhere now. Submit your answers, and we will then get the results and discuss them. Coming back while people are making their choices, feels like a US election here, to you, what you've said, Adam, in terms of complexity and standardization versus complex documents, automation. Do you see more of an application for your own firm in the equity markets, where the documents are more complex because of regulatory prescriptions? And how do you deal then with, for example, structured data in such complex documents? You need to unmute.
Thanks. I think we're going to see technology come to bear, in all different areas. I mean, our focus has been on the most complicated of documents, which are the sort of more regulated ones, because ultimately they're protecting investors, via their regulation, from IPOs, high yield bonds, retail bonds. So these are documents which are complicated in their nature and generally need to be kind of published because they're focused on retail investors, as well as institutional investors. I think, when you look at more simple instruments like, medium-term notes, these are targeted more towards regulated entities who are buying them rather than, more sort of general sort of public markets. So I think even in the bespoke regulated documents, there's a lot of information that needs to pass through, that can be passed through in a digital fashion. So I think we'll start to see technology start to impact all of those areas. And the financial data obviously is going to be XBRL format. But things like risks, etc., they should be readable, machine readable and comparable. Basic data such as company name, company number, number of shares involved, pricing of shares. This is all sort of data points that also can be automated and passed through with technology. But I don't think it's just technology impacting the structured data itself and sort of having that data sort of flow through. I think the structured data by its nature can also then have technology look to improve those processes. And that's one of the things that we've been doing at ScribeStar is by using that structured data, we can get rid of a lot of the manual processes that companies go through and their advisors go through to produce these documents. And that is one of the key ways of reducing the time to produce these documents. So I think we see the sort of usage in the big complex documents, but structured data underlying it allows it to become much more efficient and allow the processes to become more efficient as well. Did that answer the question? Sorry, Robert.
No, I was on mute.
Right.
Thank you, Adam. I was just saying that from our own point of view, it's incredible to if you're not in the capital markets, that it's hard to believe that this type of data that you mentioned and also that we digitalize is not yet available, and that we're still dealing with PDFs that are completely unstructured in 2020. So I fully agree on you. What do you think about regulation? Do you think it should be reduced? Is it a hindrance, or do you think that it should be stricter? What's your view on that?
I think, well, ultimately, regulation was brought in for a reason, and that was to protect retail investors. So I think we have to keep that in mind when we start to think about how technology changes and whether we should be reducing the amount of regulation around documents. My personal view is that we shouldn't be looking at reducing regulation, but what we should be doing is looking at systems that can improve the ease of application of that regulation. This then comes back to kind of all the sort of different standardized documents as well that people are talking about to making processes easier. I think with an IPO, having something like a standard growth prospectus is great. And it certainly helps. And for exchanges that we've been working with, like Aquis, we've seen them sort of want to adopt that kind of as a template. But if you then can have a template which has regulatory sort of aspects embedded into it digitally, so that when a company is putting the information in, it can be used to then create a document that's dynamic, that can be reviewed better by the regulator, again, bringing all the different parties in, that becomes a much more efficient process to be able to go back, maintain the regulatory sort of control of a document, but bring it into kind of like the whole process so it becomes an easier and simpler process, thus reducing the cost of capital for any issuer coming to market.
Thank you. We've just received the results of the first question. So very unsurprising, the most progress has been seen in trading and settlement by our audience, second most in exchange services, third most we have in equity issuance, and then equally in investor relations and debt issuance. I think that reflects fairly truly the reality. And companies like yours and ours and Hervé, who will speak a little later, are working on creating an environment that works almost like doing let's say a foreign exchange transaction or a transfer from your online account. There's no reason why bonds should be more complicated than that if we have the value chain digitalized. With this, I'd like to go to Peter and ask you, Peter, in terms of regulation, how do you see this and what Adam just said? Do you think from let's say a legislator's point of view, almost that regulation can help, is hindering, or where do you see your role as EU Commission?
Well, I think at the European Commission we sit in a very particular spot, and we're kind of squeezed on two axes. If you look at regulation, there is on the one hand at the European level a debate about reducing regulatory diversity, because if you have regulatory diversity, you don't have a single market, you have a lot of barriers in the market, segmentation of the market. So we want to address the diversity. But in addressing the diversity, you have to make a policy choice as to the regulatory intensity you want to maintain. So at what level of intensity do you harmonize, if you wish? And from a purely single market point of view, you can harmonize at a very low level of intensity, or you can harmonize at a very high level of intensity. The single market operates at both levels. Now, the level of intensity, of regulatory intensity you get, is often the result of market developments, and in particular, what I would call financial engineering, or sometimes even financial alchemy, that's around with very creative people who develop products that present risks, undue risks, and it is these risks, both credit risks, market risks, consumer risks, investor risks, that trigger a drive towards regulatory intensity. And the trends of more regulatory intensity, less regulatory intensity are fairly cyclical. You have a crisis, and a crisis is always followed by an increase in regulatory intensity. At a certain moment, that stops, and you see again the regulatory intensity going gradually down until there's a next problem emerging. But these cycles are very slow, and the level of addressing European diversity follows that as well. So do I say, do we need more regulation? Do we need less regulation? The Commission usually is at its best when it takes a fairly agnostic position on the level of intensity required and focuses on addressing the diversity so that we can have a single European market for this. And if I can say 2 words on the survey, I think what the survey shows is that there's a great deal of potential for further digitalization. You see some segments, there's a fairly good uptake, but our hope and aspiration is that these figures in all of these categories would end up high in the 70s, 80s, 90s%, if at all possible. We think it's possible. It is just we need to set ourselves on that road. And I'm not sure that regulation can help on that road, but policy certainly can.
Thank you. I think that's we would definitively subscribe this, all who we are here participating. We just received also the answers on the second question, where our audience would like to see an increase of digitalization. So even though it's already very highly digitalized, the highest point is trading and settlement. So it seems there are still things that can be improved. I assume this refers to clearing systems and a connection between different exchanges and other things. The second highest point is debt issuance. together with regulatory review. I think that's interesting. And then we have the third and fourth place, again at the same percentage, equity issuance and shareholder reporting. And the lowest point is investor relations. Maybe picking here on regulatory review, I think that plays what you just said in harmonization, and we've seen a movement towards ESMA rather than national competent authorities. In this respect, maybe, what about sandboxes? Do you think that sandboxes bring more regulatory balkanization, if I can say so, or do they bring, let's say, progress?
I definitely think they bring progress, but it's important to bear in mind that sandboxes, just like innovation hub, innovation facilitators, incubators, all of these things which sort of sit in a bit of a pot together, or an ecosystem, they are all supervisory tools. And while they may offer some potential for market participants and industry to experiment, most of the sandboxes that exist in the EU and even beyond don't really allow for much experimentation. But what the sandboxes do provide is a space where regulators and supervisors can engage with innovators and learn from the innovations and the technologies used to support these innovations. And in a way, my own view is that it is the supervisors and the regulators that benefit most from the sandboxes or the innovation hubs, much more than the market participants that put their activities in a sandbox or in an innovation hub. What's also quite clear is that often people present the sandbox as an unregulated field where you can sort of do whatever you like. And I think that's a wrong image. The idea of a sandbox always reminds me of kindergarten. And if you think about kindergarten, where does the teacher stand? Usually when it's playtime, the teacher stands close to the sandbox. So that's where there's most attention is being paid to the playing field. The supervisors pay often more attention to what's going on in the sandbox than what's going on in the playground in general. And even in the sandbox, while certain things are allowed, you're allowed to get dirty and muddy and so on, certain things are not allowed, or many things are not allowed. There's no screaming, no kicking, no biting. There's still rules that apply. And that's the same in the sandbox environment. It's a safe space to try things out, but it's not a free-for-all. But I'd say while the children or the innovators may benefit from the sandbox, I think sandboxes work or have most effect on educating supervisors and regulators and making them more accepting of and more knowledgeable on the use of technology to pursue market, but also regulatory and policy objectives.
Thank you. That's very enlightening. So summarizing, I would say the sandbox is here to educate regulators, but also to help grow up the kids in the sandbox so they can comply once they leave with the rules of the playground, which I think is a very good way. Maybe one final question before we pass on. In terms of Europe, and we hear a lot of kind of keywords like digital sovereignty, we hear Fortress Europe. I think there's 2 points to this. One is to create an independent financial infrastructure so that Europe can stand on its own feet. But on the other side, do you see this also as a chance for Europe? Like, for example, in the UCITS funds, which were a huge success and which are accepted now in 90 or so countries. Do you think we can repeat this in other markets by building our own infrastructure and harmonizing our markets?
I'm an optimist, and therefore I see opportunity in everything. Now, digitalization, be it of capital markets, of digitalization in general, does require a technology layer, technology stack for the digitalization to be built upon. And we see this also in other markets. And Adam, for example, referred to cloud computing as one of the infrastructure layers or infrastructure stacks that are out there. And there is a bit of a worrying trend that many of these technology stacks are non-European, or these technology layers are controlled by non-European parties. And in the interest of preserving our sovereignty and our autonomy, we must make sure that Europe has a seat around the table, because if it doesn't have a seat around the table, it is likely to be on the menu itself, and it's better to sit around the table than to be served for dinner. So we do think that Europe has opportunities there. We have great technology, we have great engineering skills, and we must bring these to bear. What is sometimes missing a bit is the willingness and the ability for risk-taking and risk capital in Europe to play its role, so that people can invest in these technologies and develop them. And people should take a European-wide or even global perspective in developing these technologies, rather than a local, narrow, sometimes even city-focused objective.
Thank you. I think that's a very positive outlook, and I think very progressive for a legislator. So much appreciated from our side. I would like now to switch to Hervé Labbé, who has an interesting journey from suffering the capital markets in his function as a treasurer, and then addressing some of these deficiencies with his new company, now CP. Hervé, maybe you can tell us a little bit about your journey and about the topics we touched about now, like regulation, efficiency, and others.
Yes, of course. Thank you, Robert. The first thing that jumps out at you when you are in charge of financing in a large company like Orange is clearly the difference between the bond market and the commercial paper market. Even if there is room to improve the bond market, at least the bond market is really a European market. When I issued a bond, there were a real diversification of investor base. I had between 130 and 200 investors spread across many European countries. I know the name of the investors, and I can organize on a regular basis some roadshows to meet investors, to discuss with them about the financing strategy of Orange, to present them the last figures of the company. So a real relationship between issuer and investor. The good question concerning commercial paper market is the following one: is it a real European market? And the answer, in my opinion, is no. No, because it's a pure OTC intermediated, non-transparent market today. The issuers, for example, don't know the name of their investors. You can't organize a roadshow to meet investors and to discuss about your financing strategy. And it's not a European market due to the fact that you have a juxtaposition of local markets. It's not a global market. And then after, when you go into details of how the commercial market works, you realize that the commercial paper market is poorly digitalized with a very complex workflow, and it doesn't allow you to manage your liquidity gap with finally the best instrument to do it, the commercial paper. I will take a very simple example. As an issuer, you receive your cash balance at between 11 and 11:30. It's clearly too late to manage your liquidity gap as issuer, but it's also the case for asset managers who receive their figures between 12:30 and 1 p.m. And as Jeremy Gooks, who is a co-founder of NoCP, said at the beginning of this project, you can order a book on Amazon website and receive it 2 hours later, but the usual settlement on the commercial paper is 2 days. There is clearly a problem. So it's why we have created NoCP. With NoCP, you can receive the ISIN code on the new CP market in a few seconds, on the European market, on the Euro CP market in a few minutes. You share the trade with all participants involved in the transaction, with the issuer, the investor, and the dealer, if you have a dealer on the transaction. You decrease, of course, the risk of error on this market, and you don't need to match, since the fact that we have the license of MTF, and it's a very important point because this license allows us to implement a relationship between issuer and investor, to be able to negotiate in the platform, to have a multilateral discussion between issuers and investors, to be more transparent. Without this license, it's not possible. No, you can do nothing, in my opinion. So on what we think we will be able in the short term, it's the fact that with a direct link with IT2S, a new CSD generation based on blockchain, we are able to have a settlement in 20 minutes. It means that issuers and asset managers will be able to manage their liquidity gap with a more efficient instrument to do it, the commercial paper. Of course, we are also linked to Euroclear, and we will be able also to improve the settlement. And as you Paul mentioned, the main point is the trading and settlement. And NoCP address this problem clearly.
Thank you, Hervé. I think that's a very good description of your journey, how you saw a problem and actually solved it. Very impressive also to settle bonds in T+20 minutes. I think this comes close to delivery of a book on an Amazon Kindle. So you clearly have taken this advice of your co-founder seriously. In that respect, I found it quite interesting that you made such an emphasis on regulation, and we just spoke about that with Peter. So you are, let's say, one of the older kids in the playground who already knows and abides by the rules. Does this mean, for example, you also see benefits out of this regulation?
Yes, of course. To be clear, regulation has a cost. To implement MTF in terms of cost, it represents perhaps 25-30% of my costs. it's clear. But on the other hand, when I go and discuss with issuers and with investors, of course, if you are able to say we have a license by AMF and ACPR, it means that you are able to prove that you have a very strict follow-up concerning your finance, concerning your IT risk, because you are obliged to report on at least an annual basis all these things to the IMF and ACPR, of course, for NoCP. So it's also the capability to say to your participants, you can deal on the platform in a secured environment thanks to this MTF license.
Thank you. And just for our viewers who are maybe not familiar with these legal terms, MTF means multilateral trading facility, and represents the same level of regulation as you would have in the London AIM market, or the Euro MTF in Luxembourg, or an open market in Frankfurt. That is the same regulation. And it allows also to trade all to all, which I think is quite also a world premiere in the primary markets that you have created here. Maybe one last quick question on the pan-European reach. So you said Eurobonds are a real European product, but does this also apply to smaller companies, or is this, in your view, more something for the big ones like Orange or other in that area?
No, unfortunately, today bond market, but also commercial paper market, are quite dedicated to the largest companies. Of course, on the commercial paper market, you need also to be correctly rated on the bond market. Also, you during the last 4 or 5 years, you have an increase on the private placement market, more dedicated to mid-sized companies like Schuldschein or EuroPP in the French market. But it must be improved, clearly, because today you have a very, very simple access for the largest and well-rated companies. It's perhaps a bit less the case for mid-size, less well-rated companies.
Thank you. I think that's a very good transfer to Fritz from DZ Bank. Schuldschein, obviously a keyword for Germany, but maybe Fritz, you can give us also a view in terms of what you how you see the role of platforms like NowCP or EPPF in competition or in co-opetition or cooperation with banks, and what you're doing from a banking perspective.
Yeah, sure. Thank you very much, Robert. You're already framing this a little bit in the way that, so you're the Tesla, and then sort of we're the kind of the British Leyland in its last final years. Let me sort of just comment on one thing that Hervé has just said. There is a structural advantage for large companies when it comes to their refinancing through the debt capital markets, which is to do with also, especially the engagement of the ECB with specific requirements to rating thresholds and to the liquidity of the trade, mostly defined as a minimum size. And many companies aren't able to reach that, or they aren't willing to reach that, the combination of both. So that's where you have a market like the Schuldschein market or the EuroCP market come in and try to facilitate some sort of access to the capital market to companies that are below that threshold that is set by market standards in the sort of liquid bond market. The comments that I'm going to make, however, are largely informed through the liquid bond markets, and that's because from where we stand at the moment, most of the platform innovation is going to be driven, so there's a big chance of that being driven through large issuers who've identified faults or shortcomings in the process as we have it now. Maybe it is some instructive idea of sort of just explaining how we look at this. So we look at the services that we provide as a broker dealer or as a sort of investment banking franchise in the debt capital markets by going through, well, what bundle of services do we actually provide in the context of bringing a bond to market, and there's a couple. So there's placement and allocation. There is the investor work that we help issuers do. There is the element of documentation, something that Adam and has dwelled upon, and you as well, Robert, are very familiar with. There is the matter of settlement. That also came up. There is underwriting. There is advice, and also the validation of the decisions taken by issuers. And at this point, it's important to remember that we do not live in a world of risk. We live in a world of uncertainty. We live in a world of politics. We live in a world of pandemics. We live in a world of populist governments, acting not maybe in the best economic interest of citizens very often. So, and all these are factors that very quickly get through to the market, and something that we as experienced syndicate managers have to deal with. And it's not quite clear to me how you could deal with that through some algorithm. Maybe a very clever one, an artificial intelligence in the far future can do so, but not at present. There is the element of trading, and that relates back to the element of investor work and allocation. So you want to be informed as an issuer, when you're a regular visitor to the market, what kind of quality you have in your order book. And that requires the knowledge of the syndicate managers to advise you on, well, this is an investor who's likely going to sell the bonds very quickly, or this is a buy and hold investor who's likely to keep the bonds and add stability to the trade, and that helps you in your next transaction. So all this is sort of feeding into this primary market service. Now, and then when we look at how we cooperate with platforms, and we do see this as a cooperation much than anything else, we look at what parts of that process or of that bundle of services is best taken care of through platforms. And of course, there is a great case for documentation. There is a great case for some aspects of trading. There is a great case for even placement and allocation. There is a little bit of a case for investor work. There is no case for advice validation, because a platform will avoid any common liability or accountability with the advice that they're giving, because a platform can't provide underwriting unless the platform has a banking license, and then it's a broker-dealer. So all these elements we balance, and we sort of think there are very good use cases for platforms. There is finally the question of governance. Many platforms are natural monopolies. That's in a digital platform market, you find that very common. And then there is the question of, would we want this? Right? That's a political question, but that's also a market question. Would we as dealers want somebody monopolizing data that we would like to have access to, or would the issuers want this? Those are the questions that we're asking ourselves, also together with our partners on the issuers side. I think sort of that really wraps it up where we stand in terms of how we look at platforms and how we cooperate with them.
Thank you, Fritz. I think that's been quite enlightening. You also have been quite active internally, basically doing your own fintech work inside DZ Bank, for example, with a product called Engine. Do you want to tell us a bit more about this?
Oh, I love to do marketing. Thank you, Robert. So when we look at these digital use cases, we also try to see what is best taken care of by somebody outside of DZ and what is best taken care of by ourselves. And when Engine this is a short form for investment generator. This is a service where we onboard investors directly to the platform, and we also have some issuers onboarded to the platform. And we, if I open Engine up, I have around currently 6,500 plain vanilla trade ideas for private placement interested investors, and about 299,000 structured trade ideas. Those are all interest rate structures. So here we use our unique client access. We use our specific legal arrangement with issuers. We use our own rating and our balance sheet structure to provide these prices that then investors and also internally the salespeople, when they advise investors on what best to invest in, and this is all for institutional investors. So we're not talking retail here, right? These, they can sift through these 300,000, roughly 300,000 trade ideas to see what fits their current investment need best, and that's one of the services that we entertain, and we feel that this is the only way we can deliver this to the market is by a bank or dealer specific platform rather than by a sort of a market utility, because a market utility doesn't have a balance sheet and so can't produce pricings on that basis. They don't have the legal arrangements for interest rate derivative swap business that is needed with issuers, and so on and so forth. So that's why we opted for our own solution for that specific use case, and this is something that we're going to build out. Because of course we're aware that we need our own digital real estate in the world of institutional banking, and that's going to be Engine at this point, and this is a first use case to establish this.
Thanks, Fritz. And obviously Engine then can connect to other market infrastructure, either established or platforms, which then makes it a whole chain.
Robert, one of the areas of cooperation that we entertain between our institutions, of course, and I'm happy to mention this here, is that we're using your term sheet generator in order to put these trades up. This is again an element where an external platform makes a lot of sense, because ideally you want term sheets that are pre-agreed in their form and standards between issuers and the dealers, so that you're quick when you devise a trade, and you ideally want to have automated debt issuance programs, so that we have on the legal documentation work we have it a lot easier, and we can very quickly produce the final terms after a trade is closed, and sort of. So that's also stuff that we are integrating in Engine, but that's then sourced from outside of DZ because you're better placed for doing this, and that's a clear case for the use of how a platform can supplement our services very well.
So it seems that there is let's say a natural evolution of cooperation. I always say, actually, I would like to have someone like a bank on Amazon, because if I search for a certain product and then I get 150 different offers from €2 to 250 euros, from made in China to made in Germany, I would actually like to have someone like in an intermediated market, who tells me in 2 seconds this is the best product for the best price, rather than having to go through mostly fake customer reviews. So I think all of us here, we agree on the role of banks and intermediated markets being actually more efficient. This leads me then to the final poll question. So to the audience out there, wherever you are, we will ask you now, which of the following do you see as the biggest barriers to adoption of new capital markets technology? Based on your own experience and what you've heard now, legacy IT complexity, legal regulatory concerns, cross-border IT security, lack of budget, reputational concerns, lack of senior sponsorship, too many parties involved creating complexity, or technologies available aren't appropriate. We would be grateful if you could fill this out, and maybe Fritz, while we wait for the results, you can give us your view on the current tech. I think you've done a huge bond now with, I think, an order book of 170 plus billion. How does that work? Is it good? Is it bad? Is it improvable?
Well, that's a nice case study for the use of digitalization in this market, right? So yes, indeed, we had the great privilege of being one of 5 book runners on the last EU trade, a dual tranche, 5 and 30 years, with an order book of over 175 billion in the end. So Peter, thanks also to you at the European Commission. The trade had so this dual tranche had over 1,000 orders, and then the process of allocation becomes very cumbersome, and it becomes a bottleneck for pricing on the same day. We have an allocation engine that we've developed to identify sustainable investors. It's called ESG Locate. It's not yet quite finished, but it is it gives us a taste of what can be made possible with a clear identification of what type of investors we face when we see each investor in the book, how we can identify clearly who the investor is, rather than have some identifiers that are more or less arbitrary, and then you first have to get to grips who the investor is, and so that's cumbersome, and that needs improvement definitely, and that's one of the takeaways that we've had from the latest transaction with the European Union. Can I ask a question to Peter?
Sure, shoot.
Peter, there is this draft legislation in Germany allowing crypto bonds. I think it was published this summer, actually. Do you see a chance of a mirror legislation popping up on European level?
I think maybe to specify that the German law says about generally dematerialized securities, not just blockchain and DLT.
But they do mention, especially they mention crypto bonds, right? So they do want to allow for blockchain determination of what constitutes a bond transaction.
Well, we have currently a proposal on the table for crypto assets, but these are crypto assets that are not financial instruments. We also have a legislative proposal for a pilot regime to support distributed ledger-based trading venues and central security depositories, in particular, or market infrastructures. But to your specific question of whether there's going to be European legislation allowing dematerialized bonds or crypto bonds or digital bonds, there is actually no European legislation requiring them to be in any particular form. Actually, if you look at the European legislation, it doesn't describe what a bond or a share or an equity participation is. This is really governed by national law. And certain member states have a functional approach in their legislation and just describe these instruments based on their functions, whereas others have a much more Cartesian approach and describe also the technology features or the carriers on which these instruments are issued. And the case in Germany was more Cartesian, if you want, and to allow crypto bonds to operate, they needed to change the legislation. In other member states, that's not really necessary. But there is at this stage no strong demand to harmonize the technical or technological or format features of financial instruments in this way. There is no strong demand, and to be quite honest, I also don't think there would be strong support for it. As you probably know, MiFID, for example, does not really define what a financial instrument is. And I don't think that a European consensus on a single definition of what is a bond or what is a share, that such a definition would be forthcoming, because these issues ultimately are closely related to property law and civil law, and that is by definition national.
Thanks, Peter.
Sorry, I'm on mute again. After 6 months of COVID, I should have got used to this. We have the poll answers in. Interestingly, it is 33%, the largest answer part, goes to too many parties involved creating complexity. So this shows that seems to be a need for an industry utility approach type of view, so that you don't have to deal with lots other. The second is legacy IT complexity. Third one is cross-border IT security. And then we have 4 which are at the same percentage, which is legal regulatory concern, reputational concern, lack of senior sponsorship, and technologies aren't yet appropriate. Quite interesting. We have also a few questions from the audience. We are conscious of time. We have one from Neil Shah from Edison Group, who is asking how can we improve the access for SMEs as they're facing a challenge accessing capital markets and active management is in decline. How can digitization open up different pools of capital, for example, retail, private wealth, or others? Maybe I think, Adam, you can say something to this.
But definitely. I totally agree. I mean, SMEs is definitely a key focus area for us, because one of the issues that we've seen is Europe economy is improving. SMEs coming to market and raising capital is absolutely critical. But the issue is, when you look at the cost of raising capital for an SME coming to market, the total cost can be 15% or something of the amount raised, which is a very, very significant amount. So what we've been doing at ScribeStar is looking to try and improve that process. And again, we've been working with different exchanges to try and see how do you find a way that SMEs can work with exchanges to raise capital in a much more efficient way. By the fact that we can reduce the amount of time on a prospectus by about half certainly goes a long way towards that. But then by digitizing the process and the data flows, again, really helps SMEs. So our focus is very much on the SME space and how we can improve that sort of process to come to market and raise capital. And so what you'll start to see is different exchanges finding different ways to improve that process and focus on SMEs. And that's a way of them coming to market without without sort of foregoing sort of regulatory issues, but making sure that they comply with regulatory issues by having those eased through kind of creating digital templates of prospectuses that then need to be tailored to make the sort of situation bespoke to that company as well. So we've been sort of very much focused on SMEs.
We got a second question, which is also for you, which I think you can answer quite quickly. If there is any underlying technology you're using to automate and connect to exchanges, which is unique to ScribeStar?
We believe that we need to connect with exchanges in the way that they want to. This is why APIs have become so important. I mean, fundamentally, our data set comes out as in an XML format, which the CMU has stated is the way it wants to sort of create data. So we have to be able to make sure that we comply with exchanges. So we don't have a proprietary technology in terms of the data that comes out. We're trying to fit in with the ecosystems that are available out there at the moment, so that we become kind of agnostic in terms of the data that's needed.
Thank you. As from the, I'll encourage the audience, please send more questions if you do have more doubts or requests to our experts. We have 5 minutes left. Summing up a little bit the discussion that we had so far, it seems like a way to provide smaller companies and municipalities and others access to capital markets is to first build it for the big companies and then use these processes that are once digitalized and harmonized and thought through also for smaller companies. Maybe Hervé, is this a way you could see the market going?
Yes, of course. But one thing quite important, I have been working with the Banque de France for 2014 to promote commercial paper market, the new CP market, with a mid-sized company, the largest mid-sized company, of course. And so 6-7 years ago, a lot of companies thought that commercial paper were dedicated only for CAC 40. So the first step, in my opinion, is to promote also this market with mid-sized company, and the result is quite impressive. 7 years ago, there were 50 participants on the new CP market. Today, you have 125. So it's the first step, the easiest step, and then after you can also, but you need to separate commercial paper for the largest company, including the best mid-sized company, and then after we need to create another market for perhaps less well-rated company and mid-sized company. So of course, and it's also the case for EuropeP and Schuldschein. We need to promote this market, of course.
Thank you, Hervé. Peter, maybe a quick follow-up question in that respect. Do you think there's anything that regulators or legislators, in your case, can do to make the market for smaller companies more attractive? Mostly what we hear in the discussion, it's about the credit quality. We see in other countries like the US or Germany now with COVID giving, let's say, government guarantees or similar. Could you imagine similar, I don't know, credit enhancements or so on an institutional basis?
Well, I don't think there's a silver bullet for this. Smaller companies have more difficulties accessing capital for a number of reasons, and the most important reason being that they're small. And once they grow or they get access to capital, this gives them also even more access to capital. So it's a bit of a self-fulfilling prophecy almost. There's a number of tools that are available, but I don't think there is a magic wand or a single solution that would serve all companies throughout the EU, all small companies throughout the EU equally well. It also depends a bit on the structure of local capital markets, because in particular smaller firms tend to access capital, seek capital locally, often still very much bank dependent. In other countries, there's a bit more openness and a bit less bank dependency. So you have to really look at local situations. The idea or the aspiration often is, or the imagination of people is, that all of these companies will sooner or later list in one of our major financial centers. But I think that's very much a dream and an aspiration and not really a reality. But for companies that do want to access capital markets and our larger financial centers, we should make it easier. And the rules that are currently in place to access these markets are complex. They invoke a lot of legal costs, a lot of compliance costs, and automation, the way we discussed it here, reduces that, makes it easier for smaller companies to access this. That doesn't mean that it makes it friction-free, but it makes it easier. Because one of the things, the biggest contribution that digitization offers to capital markets is that it obviates the importance of location and proximity. Is that if you operate in a digital way, you can be anywhere and transact with anyone. That means that you can also acquire or access capital from anywhere, provided, of course, that you present yourself in a way that is standardized, that people far away can also recognize, that they know what it is they're buying, they know what the company amounts to, what its balance sheet may be, what its product range may be, what its cash flows may be. So these kind of this information needs to be readily available for investors, for the supply side of the market, willing to put money into these companies. Thank you.
Thank you. Conscious of time, that 2 hours over.
Sorry, can I just say one thing? I was just saying, I thought Peter was, very sort of like spot on with his comment there about sort of SMEs being able to raise capital from anywhere, but also being sort of needing to make sure that they can comply with all the sort of right regulation, and it being costly. I mean, it is costly, and that's why automation is very important for these kind of companies in particular.
I mean, I can't add anything to this. Fully agree on that. Maybe Fritz, one last quick question for you. Where do you see capital markets in 5 years?
That's a nice one. I would still see it fairly segregated along national lines with smaller companies. That's a function of the legal backdrop. Peter's alluded to this. There is a couple of just national legislation that will prevent, or that will be a serious obstacle to a full capital markets union. That includes the harmonization or the lack thereof of national insolvency laws, just to mention one of those critical ones. I don't think that will be resolved within the next 5 years. But I think we will have 1 or 2, maybe 3 at the most established platform providers for the liquid European bond markets, and I think there we'll have some use cases that will filter down through to also help with market access for smaller companies. So that I'm quite confident about.
Thank you very much for this outlook. Thank you all for participating. Thank you all for dialing in. Have a nice day. And please don't forget to join the next seminar on the 9th of December on sustainable finance. we certainly will tune in, since this is the other big topic in capital markets coming forward. Thank you very much and have a nice day.
Thank you.
Thank you, Rob.